This series of the 2025 50 Faces podcast is supported by Eagle Point Credit Management. Eagle Point Credit Management is a specialist investment manager principally focused on income-oriented credit investments in niche and inefficient markets. Currently, they believe that Eagle Point is the largest investor in CLO equity in the world and one of the largest non-bank lenders focusing on providing financing solutions to credit funds. This series is supported by Benefit Street Partners. Benefit Street Partners is a leading global alternative credit asset manager offering clients investment solutions across a broad range of complementary credit strategies, including direct lending, special situations, structured credit, high-yield bonds, leveraged loans, and commercial real estate debt and equity. As of December 31st, 2024, BSP Alcentra had 77 billion of assets under management. With our next guest, we dive into the intricacies of NAV financing, although we should caution that this is not a term that he prefers. Hear from him how this strategy has actually been around for quite some time and why it is so important to elevate a pitch, an idea, and the service level that we afford to our clients. I'm Aoife Devitt, and welcome to the 50 Faces podcast, a podcast committed to revealing the richness and diversity of the world of investment by focusing on its people and their stories. I'm joined today by Tom Doyle, who is partner and head of NAV financing at Pemberton Asset Management in London, a role he's held for over 3 years. He previously held a similar role at 17 Capital. He started his career in capital markets. Welcome, Tom. Thanks for joining me today.
Thank you very much, Aoife, for having me. It's great to be here.
Well, let's start just with a little bit about your background, and then we're going to plunge into the overview of NAV lending and what we're talking about when we discuss that. Can you just tell us briefly about your background, where you grew up, and how you came to enter the world of finance?
For sure. I'm an Irish national. I grew up in Ireland, grew up in Southwest Ireland in a very rural town, a town of probably 3,500 people at the time. Went to primary school and high school there and ultimately ended up in university in Dublin. University College Dublin, where I did a Bachelor of Commerce. And that's kind of how I started, or at least my journey in finance was through that finance degree.
And did that take you then to London and into the world of capital markets immediately?
No, I would say that my career very much has not been linear, at least not at the beginning. I think actually it's been interesting for that exact reason. I started my career in retail and commercial banking for a number of years. Then I moved into financial reinsurance with a Bermudan reinsurer. And through that role, I ended up looking at portfolio finance for a reinsurance company and ultimately started some of those desks at banks. And then for the last 20, 25 years, I've been involved just in that financing. But the beginning of my career, like I think many careers, was non-linear and more fun for that reason.
Certainly, it brings that combination of experiences to bear when we get into the mainstay. So now going to NAV lending, can you just give us, I suppose, define it initially? Maybe give us a little potted history as to how it evolved as a strategy to invest in.
Let me define it first, because I personally think it's the worst naming convention that we could possibly have for an industry. I hate it. just to be a bit controversial with it. NAV financing, net asset value, literally just relates to the valuation of a fund typically. So what we're talking about is fund finance or lending against the valuation of a fund. I don't really like that because it's kind of a bit nebulous as to what it means. It could mean any type of fund, any type of asset class. I prefer portfolio finance. So therefore it's an asset-backed type of strategy. We are lending against the valuation of assets that are contained in a fund. And across that spectrum, you could have any type of lending, portfolio finance lending to mutual fund assets, hedge funds of hedge funds, private equity secondaries, private equity primaries, real estate venture. You could have any type of lending where the portfolio is contained in a fund. The type of NAV that I think we are talking about probably falls into two categories. The category that we profess is private equity lending against the assets contained in single buyout, private equity buyout strategy funds. Or I guess you could say, things like private equity secondary funds, direct lending funds, etc. That seems to be what most people consider NAV today. But in my career and people like me, we have lent against many, many different types of NAVs. or many different types of portfolio assets. But I think the one that, is most commonly used for NAV is this private equity buyout space. That's the one that is kind of coalesced around. The answer to your second question, the history of it, it always amuses me that people think it's new. I think personally NAV finance has been around since the day after somebody published a NAV in a fund. Somebody was probably trying to borrow it. I've been doing it for 25 years. I'm not the first. I'm probably one of the oldest still doing it. But I'm not sure I don't think that's a particularly useful thing to say it is new, because it isn't. It's been around in banks for decades. I've been doing it for decades within banks. I've now been doing it for several years outside of banks in non-banks. And, it is important to understand that history. This was a strategy and a business contained in banks serving their clients who were looking for either leverage or liquidity against their holdings in funds on various, cross-asset basis. And recently what's happened is that banks, like many other strategies, have become more constrained. So it's harder for them to hold some of these assets because they're not particularly good from a capital perspective. And actually, I think even a bigger reason is just size of some of these transactions challenges them on a balance sheet basis. They're just very, very large transactions, and it's very hard for a bank to hold some of these unhedged large balance sheet items on balance sheet. Hence the rise of non-bank balance sheets as an answer to that dilemma, perhaps. So that's, your part of history there. It's been around forever, and it's got sort of new followings in the non-bank space over the last maybe decade.
That's really interesting, because I think because maybe it's only recently available to invest in as a fund for, say, institutional or other investors, there's a perception that it's a new practice on the part of private equity firms to obtain NAV lending. So are you saying that it's not a new practice by private equity firms to obtain NAV lending? It's just a relatively new practice to have that outside the banks?
It's a bit of both, as you can imagine. Within banks, it was always there. Pre-crisis, it was seen as a sort of a relationship transaction for the larger client. Post-financial crisis, it sort of went away for a while, and that allowed for some non-bank players to dabble in it, to come into it. Of late, it has become much more mainstream in the private equity buyout space. So whilst NAV lending, again to use that phrase, has been around for decades, I think it has definitely grown or even exploded in the private equity buyout space. Previously, it wasn't as popular there or wasn't as used in that space as it was in other areas. Like, for example, if you think about it, the hedge fund space, the hedge fund industry has a whole business unit in banks called prime brokerage. And all they do is essentially provide portfolio finance to hedge funds. Private equity hasn't had that type of service from banks. And, I think since the financial crisis, maybe since around 2012 or thereabouts, private equity buyout space has shown a lot more interest in these types of instruments. So not a new practice, but definitely the private equity space has grown in its utilization of that. And there's a couple of reasons, and maybe that is of interest to your listeners, is the reasons why that has happened. So I always say that, some very, very bright people go in, they do MBAs, they study to go in to be, private equity practitioners, and their whole world is being focused down on the underlying companies that they purchase and improve. And they go in and they say, how do I grow the EBITDA on this company? How do I minimize costs? How do I grow turnover? How do I do add-ons? They're very, very focused on the activity of the underlying portfolio companies. Unlike many other industries actually optimize at the portfolio level. And I think that's what's happened is COVID acted as an accelerant for this topic. It showed that you couldn't always optimize at the individual company level, that you needed to optimize at the portfolio level. I think that actually as competition has grown in private equity, lots of new entrants, a lot more competition for transactions, there has been an added requirement to optimize at the portfolio level, not only at the individual company level. So in many respects, I see it as a natural evolution. I've always seen it as a natural evolution, which, given my experiences in other asset classes, is very, very natural. It's just a very natural evolution. It sometimes might seem to the outsider that it's suddenly there's something new and something maybe even dangerous or maybe even, definitely novel. But actually, if you track it, as I have in many other asset classes, you've seen that this is business as usual, and other asset classes are now just being applied more commonly to the private equity space.
And I suppose not all funds are created equal. Not all NAVs are created equal. One of the challenges of private equity right now is getting a handle on the true NAV, true valuation question. How, as a lender, do you get comfortable there?
Very good question. All reputable private equity managers, they, will spend a lot of time making sure their valuations are true to life, shall we say, fair market value, all that. When we look at our transactions, we re-underwrite the valuations on each one of the companies. We're kind of rather novel or unique in that regard. It's not always the case. We actually, maybe interestingly, probably of the view that most valuations at this stage are probably a little bit overdone. That's not to say incorrect, because they're not selling today. But we often think that the valuations are probably over by 15 or 20%, which we think probably has led to sort of the mismatch in liquidity in the market, because people won't sell at a 15% discount and won't buy at a 15% premium. So we think that is adding to the clearing price, or so the issues around clearing price in the market is adding to that liquidity issue. But in terms of how we look at it, we are looking at cross-collateralized, diverse portfolios, diverse in our world, 10, 15 companies. We re-underwrite the valuation, and we only lend at like 10, 15% of that value. So we think that, let's assume the valuation of 100 is published. We think it might be 90. We're lending at 10% of 100, so our margin for error in that valuation underwrite is very, very low. It doesn't need to be so accurate, because we've so much cushion in that, but we still do that re-underwriting from scratch.
We're going to take a short break to hear from one of our sponsors of this series, Eagle Point Credit Management. I sat down with Tom Majewski, founder and managing partner of Eagle Point. I asked him what opportunities he saw today that excited him.
One of the things that we're most excited about, and a lot of what we do at Eagle Point involves investing in CLO equity, the opportunity to unlock value in CLO equity or create value through being a majority investor today is tremendous. And some of the rights we have as a majority investor, and these are protective rights that an investor might have, but the opportunity to either call a CLO or, more interestingly, reset a CLO. And what resetting a CLO means is you keep your same assets. You might have 150 or 200 assets. You're very happy with those loans. Pay off the old CLO debt, pay them back at par plus accrued interest, and then issue new CLO debt at much tighter spreads.
And now back to the show.
Just in terms of, say, an investor's perspective, investing in, say, one of your funds, how should this investment be characterized or thought about? Is it simply another form of private credit? Would it be maybe, is NAV lending shorter term in any case? Is it some kind of a bridge lending? Do we think about it in a kind of more shorter term way? Return-wise, where does it sit on the spectrum of private credit?
And again, this goes back to the whole convention or the naming convention. What is it? So, let's talk about NAV financing. If you think about fund finance or NAV financing, you could probably go down as far as subscription lines, on sort of one end of the fund finance world. That'll give you sort of LIBOR plus, 180, 200 basis points in the current world. And you can go all the way up to sort of more esoteric, concentrated NAV financing in funds at, mid-teens. So it's very, very important that when we talk about the investment opportunity, that we're correctly categorizing what we're actually talking about, right? So on one level, you've got investment grade sublines. That's fine. We don't do that. We don't think that's amazing, relative value at the moment. The next level up, you have lending to direct lending funds. That's also NAV lending. Lending to credit funds. That's probably LIBOR plus 200. We think it's good risk, but we don't think it's great relative value risk. You're getting 200 basis points. Another business that I built, during my days at JP Morgan was lending to private equity secondary funds. The first transaction I did there was LIBOR plus 400 basis points, great relative value. That market is now, say, 200 basis points over. So we don't think that's great relative value. So therefore, you're sort of go. We think from a relative value point of view, we think there is better value in the area that we profess and that we have focused on. So we are focused on the areas where we're lending to single fund private equity. We think we have an angle or an advantage in terms of how we source and how we cover those managers in Europe. We also think we have an underwriting bias. We have, the ability to underwrite that. We have 21 credit analysts looking at these kinds of companies. So we think we have an advantage there. So from a relative value perspective, in the fund finance space, we have focused on private equity buyout in Europe, single fund private equity buyout, where we think we can get between call it 500 and 600 basis points over. So from a relative value point of view, that's our focus. That's not to say other areas are bad. We just don't think the relative value is there at the moment, right? So we are focused on that area. Where do people put it? That question has actually stopped a lot of people investing. They don't know where to put it. It's kind of where do you put a new asset class? Do you put it in as a new asset class? Do you put it in as specialty finance? Do you put it in as private credit? I think that has held the market back and continues to hold the market back a little bit. I would probably say it goes into private credit. These assets are investment grade. So you have investment grade assets formally rated by external rating agencies, and you have essentially non-investment grade returns. So it's actually, that's why we think it's a great relative value transaction. It probably fits in to private credit, as a sort of an additional investment to your usual direct lending. Kind of broadly speaking, it is corporate credit. It is very strong connections, in terms of underwriting and origination. If I were an allocator, I would put it into private credit. I would probably put it into an IG bucket. It's amazing for insurance companies, for example, in their private credit area. Now, then there are, and I think it's worthwhile saying this, there are other areas of NAV finance that we also profess. We also do GP financing. That can probably fit in again to specialty finance, private credit, could even fit into your private equity buckets. What we often say, and some of our investors, they say, the relative value is so good, you'll find a place. Be open-minded about it. Don't say, oh, I don't have a place for it. Because we actually think the relative value here relative to many, many other asset classes is tremendous. And I guess it is important to say, we're speaking today when the whole Trump and tariff world is happening, for your listeners that into the future, we're having this conversation right in the middle of the week when he has launched these tariffs. This type of volatility, this type of uncertainty that has been unleashed on the world is amazing for strategies like mine. First of all, it's portfolio finance. So you don't have to pick winners and losers. We because it's portfolio finance, we can take advantage of the winners and the losers in the portfolio. So we have that sort of insulation. This type of strategy is great for volatile periods. You don't have to be 100% right. We are lending 10% against portfolios of diverse companies, diverse strategies. There will be winners and losers in those portfolios, and we're lending at a very low level against them. So it's a really nice time for us. As we've discussed in the past, this is not a happy environment, but it is nice to kind of think that some of your investments are more insulated than others in this environment.
And I'm sure that's true, and that's certainly nice to know that there are diversifiers in this environment. I suppose just the final question from a technical standpoint, where does this lending rank? If there is other lending, say, undertaken by the private equity sponsors, just, given there may well be some cracks in that enterprise at some point, given some of these valuations from the public side may percolate to the private side eventually. And I suppose just use of proceeds, we're not talking about subscription line financing, but, is this just general use of proceeds to reinvest in the portfolios, or is there a kind of a general guardrail around that?
I can answer both of those. In terms of ranking, so again, we're lending on a cross-collateralized basis to the equity of, call it 10 or 15 companies. In terms of ranking, we are more junior than the individual direct lending or loan to the individual company that is senior to us. So on an individual basis, we're junior, but then we cross-collateralized across the 10. So here's kind of the alchemy, if you will, to use a strange word for it, but it is a form of alchemy. Most of, we're lending to middle market companies, primarily lending to middle market portfolios. The individual debt in each one of those portfolio companies might be, say, B or double B sort of rating. But actually, because we are lending on a cross-collateralized basis, on a portfolio basis, our loans to the portfolio are actually investment grade. So even though we're junior on an individual basis, because we have that cross-collateralization, we end up with this alchemy, we end up with this investment grade product. Because think about it, you've got the equity, say, value of 100, we're lending 10 against it. So even if each, 8 or 9 of the individual companies default without any recovery, 1 or 2 of those companies surviving will be sufficient to repay the loan with full interest and perform. So it is actually ranking formally more junior on an individual basis, but we have 10 of them, in terms of the portfolio. So that explains the investment grade. Use of proceeds, definitely a guardrail. We very much control the use of proceeds. Broadly speaking, there are 2 or 3 use of proceeds. One, it's to buy an additional portfolio company towards the end of the investment period. They might have bought 9 companies. They might have expected to recycle one of those companies already, to have sold one of those companies during the investment period of the fund. That hasn't happened. So to keep the investment pace of the fund up, they may have purchased an additional company towards the end of the investment period. Post-investment period, in the harvest period of the fund, they might use our capital to grow a company. So, add-ons, as a source of capital for add-ons and bolt-ons in individual companies, or indeed to defend the company. Some of these companies that have been bought over the last couple of years are in, great companies, great sectors, but perhaps have the wrong capital structure, maybe too highly leveraged. So you can cross-collateralize, those 10 companies, get some proceeds from a loan, 10 or 15%, and drop that down into right size portfolio companies' capital structure. That's a good use case. And unfortunately, about 20% of our pipeline or 20% of our inquiries relate to dividend recaps, i.e. liquidity transactions for investors. But that explains about 100% of the conversations I have with clients around the use of proceeds. We actually haven't done a dividend recap transaction. We haven't needed to. It's definitely a feature of the market, but actually a lot less than people think. We very much advocate that when a GP contemplates a dividend recap transaction, that they go out and explain it to our LPs. Often the LPs really need that liquidity, and I think that's going to happen into the future. They need it, but like all good LPs, they don't want to have the wool pulled over their eyes. They want to make sure that the GP is treating them with respect and giving them the transparency that they need. We fully support that. So that would be the fourth use case, would be a dividend recap, to provide liquidity to LPs. But again, that has some controversy around it, but actually is only, in our estimation, about 20% of the transaction volume in the market.
We're going to take a short break to hear from one of the sponsors of this series, Benefit Street Partners. I sat down with Rich Byrne, President and CEO of Benefit Street Partners, and asked him why working at a firm of this size creates unique opportunities to set culture.
At Benefit Street Partners, we're barely 250 people. And that's still a size where you can have your fingers in all the pies and know all the people. I know the people less well, maybe, than when there was 100 people, but you can still know all the people. I think there'll be a point in our growth where that's going to be much more difficult to do. But while we're at this size, I think that culture is something that we can carefully curate to, be a powerful weapon for us. I think it involves, and doing that is, just like I said, sort of leading by example.
And now back to the show.
And I think you've done a really good job of kind of explaining the evolution of this asset class and maybe some of the misperceptions there among it. One of the things that you said when we first met was around growing acceptance of certain strategies and how we normalize certain strategies, such as, for example, GP-led secondaries, which were quite unusual and now represent the lion's share of secondaries transactions. Do you think we're going to see a similar normalization of NAV lending, or whatever we call it, fund lending, as years go on?
I certainly hope so, because that's what I've sort of bet the next phase of my career on. But more seriously, I think it's already in the system. And I think there's some good proxies for this. If you've been around for as long as some of us have been around, you've seen this dialogue played out many times before. It's all about explanation, education, transparency, discussion, controversy, newspaper articles. It's all about that. It's all kind of part of the normalizing of some of these strategies. And you go back 10, 15 years, you go back 20 years, it was probably dividend recaps by individual companies. You suddenly had, a distribution for a capital account, and you said, well, where did that come from? Well, it came from an individual company doing a dividend recap. That was controversial. You go back, say, 10 years, you had the whole controversy about the use of subscription lines. They were going to be dangerous, and it was financial engineering, and it was synthetic. And how that has been normalized, like now I would say that private equity buyout firms, about 80% of them have a subscription line. And the way that is monitored is it is a dialogue between LPs and the GP as to its utilization and how it can be used and when it can be used, and the tenor and all those kinds of things. I've had those discussions with our own LPs and come to an arrangement with them on our sublines. And I think this is the same thing. LPs should and want to be treated with respect. So, we have dialogue, and I'm sure all other GPs will have a dialogue with their LPs saying, we want to be able to have NAV loans as part of our toolkit in order to kind of deal with requirements for capital post-investment period, requirements to deliver liquidity to you post investment period end, et cetera, et cetera. So I think as long as it's transparent, as long as it's disclosed, as long as it's negotiated, perhaps, that will normalize it. So my take on it is that it's already in the system. Those discussions are already happening. Post-COVID, many of the large GPs have used this type of facility. So I think it's going to become as big as sublines will be and more and as normalized. That's my take on it.
Great. Well, we will continue to watch the space. I'd love to just turn to some reflections now. You mentioned having had a career that cycled through lots of different sectors. Any particular learnings or setbacks that led to lessons learned or insights from any of these sectors that you can share with us here?
Setbacks, I think, at the time are so awful. And I remember being in the doldrums many times in my career. It just seems to me that when you have these setbacks, it's just to have some perspective on them because it's so hard. And I even, as recently in the last couple of years, when you have career setbacks or fundraising setbacks or whatever, it's just have some perspective and keep going. And I know it sounds trite, and it is trite, but the alternative is what? You just sit back and you wallow in it. So for me, the greatest lesson I've had with setbacks is just to keep going. That's always been kind of my motto.
And I think it's interesting because you work with so many private equity, say leaders or fund leaders, that I think having had a few cycles of, say, market downturns or things not meeting expectations, I think that's when we get the true insight into human psychology during these times of strain. I probably learned more during 2002 and some of the investment banking challenges there with clients about how people behave when times really get tough, which I think is a due diligence asset, actually, being able to kind of read personalities and fit for those type of setbacks. So I do think it has, if you can sort of somehow crystallize what you've learned there, or at least file away, I think it can be really interesting going forward. Were there any particular key people throughout your career that were mentors or sponsors or made an impression on you?
What is it? They say it takes a village to raise a person or something like that. And I think careers are no different. As you were just speaking there, I was thinking of maybe three people, all the teachers that I've had, some of them were inspirational as a young man. But I definitely think there were probably three people in my career that have made the most difference. Two Indian gentlemen, completely coincidental. One was a very, very dear friend of mine and boss, definitely a mentor, was a guy called Sajid Sirpal. I worked with him for many, many years until his untimely passing. I learned so much from him. His sense of humor, of course, was brilliant, but just how he dealt with people and business, I thought it was fantastic. Another Indian gentleman I worked with before that was a guy called Jamel Singh. I think he probably holds the accolade of teaching me how to think. Everything had a different perspective, and I really, really enjoyed working with that. He just taught me how to think differently. And I would even say, and you'll probably be embarrassed to hear this, but actually my current managing partner, Simon, as old as I am and as experienced as I think I am, I've still learned a lot from him. He's truly a visionary in terms of what he's doing with this business. But he also has been, I guess, a great mentor to me in building this business. Building businesses is terrifying. Building businesses takes a huge amount of humor. Building businesses takes a huge amount of resilience and all these things. And it's been great to be in the boat with him doing that. So he's been a great support, great mentor to me. But those three guys, in very, very different ways, I think have shaped me over the last 25 years, which is just nice to give them that thank you.
That's wonderful. As a fellow Irish person, I will share your shout out to the Irish teaching profession, which I think was really kind of, I'm not sure they certainly made them in a very unique way back then. Really career, mission-driven teachers that I think we probably still remember their names, their quirks, their one-liners. And really interesting what you said about humor. I don't think I certainly could maybe dedicate a whole PhD to this, but I think humor certainly is the glue that holds together enterprises in rough times because it makes it bearable. So I think that's really interesting that you mentioned that because I've definitely noticed that sort of in passing, but never expressly focused on it. So I think that is probably really key, certainly in the growth phase. My last question is any creed or motto you might have, or either advice for your younger self or any wisdom that you've picked up along the way that you can share.
It's so hard. I mean, you talk about PhDs. This whole conversation of the last half an hour has made me remember so many different little episodes of my career. I might even write them down myself because they've made me laugh and cringe in equal measure over the last while. I think the one thing that has struck me about now mentoring people, younger people in my business, or, as I speak to people, is the word elevate. We all have an opportunity to deliver service, to deliver papers, to deliver a phone call, deliver a presentation to a client. That client doesn't have to be there in front of you. So, the word elevate often comes to my mind, and often is used by me in my interactions with the team, which is, okay, that was great. Let's elevate that pitch. Let's elevate that presentation. Let's elevate that service. So that's kind of my motto, if you were looking for one, and I just thought of that word, but it is often a word that I use in my dealings with people, is to elevate. You can always go that one step further.
Thank you so much, Tom. I think you have elevated our understanding of NAV lending, fund lending, portfolio lending. We now even have a broader vocabulary to use for that. And I think this is an exciting area. It is a misunderstood area. And that was really why I use the word amplify a lot. I try to amplify ideas to really help us understand them better. And I think we've gone a long way with this strategy, which has been somewhat opaque, I think, for investors and for onlookers. So thank you so much for coming here and elevating our understanding for us.
Well, thank you for your time. It's been very flattering to be invited, and I thank you and your listeners. Thank you very much.
I'm Aoife and David. Thank you for listening to the 50 Faces podcast. If you liked what you heard and would like to tune in to hear more inspiring investors and their personal journeys, please subscribe on Apple Podcasts or wherever you get your podcasts.
This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organisations and affiliations of the host or any guest.